Hello, ACCA students. Welcome back to ACCA MOXIE. Now we are going to do the section B questions that are based on scenario. So you have given one scenario, and based on that, you have to give the five. You have given the five questions, and out of these five questions, you have also given the options and you have to select these options. Okay, so for this we have to first read the scenario, and then we will try to read the requirement, and then we answer the question. Okay, so the first is the brass company, that is a new buy of sophisticated borrowing under the secured loan, and this company leasing issue. So this question is related to lease versus buy. Okay, lease versus buy. So this is relevant to investment appraisal. This is relevant to investment appraisal. So we will leave this here and we will do this in the later when we solve the investment appraisal question. So this is not relevant to business finance and cost of capital. Okay, so we have to move on to the next question. So next question is Kelvin. Kelvin company is considering an extensive right issue to raise the finance. So Kelvin company is raising the new finance through the right issue. It currently has 4 million. Currently it has 4 million shares and has been successful over the prolonged period. Okay, the terms of the deal are as follows: one new share for every four, one new for every four. Okay, and the issue price is 90% of existing market value per share. So existing market value is $20 per share. They come right. Okay, one of the directors is unhappy with the offering any discount to existing shareholders. The directors is unhappy with the discount that is given to existing shareholders. He claims that the company past success should be enough to encourage shareholders to increase their investment. Okay, so we have to calculate the theoretical x right price. So you know the theoretical x right price, how do we calculate? So just remember, this is the simplest method. I will tell you how to calculate the TERP. So you have to write the existing shares. Okay, existing is 4, then you have to plus, and then you have to write here the 1 for every 4, and they will get the 1 right issue. Okay, so you have to write this. Okay, 4 here, then plus, then 1 here. Okay, then you have to multiply it 4, then you have to multiply it 1 by 4 as well. Okay, so and you have to close this bracket because you have to multiply this by the price of each in the market value and the right issue price. Okay, so the market value, the existing market value of the existing shares, these are the existing, is 20, but the right issue is issued at 90% of the market value. Okay, so 20 into 90, 20 into 90, how much? 20 into 90% is 18%. 18, right? 18. Okay, so we have the 4, we have 4 plus 1, so we will write here the 5. Okay, so how much is the TERP? TERP is now here is 19.6. Okay, 19.6. Okay, so I will write this here, 19.6. Okay, this is the $19.6 per share. Okay, okay. So the next question is, what would be the effect? What would be the effect on TERP? Effect on TERP. This, what is the effect on this? Okay, so how much this value change if the value of new shares offered, if the discount offered, if the new issue were offered at 20% discount level, while while raising, so here it is only issued 10% discount. Okay, 10% discount, it is given 10% discount, but now we are offering the 20% discount. Okay, while raising the same amount of finance. Okay, this same amount of finance you are going to raise from the right issue, which means this amount will be the 18 here, 18. Okay, so I will write same, exactly same everything here. So 4 multiplied 20, 4 multiplied 20 plus multiplied how much is the discount, how much is the discount, discount is 20%. So now you have the 20% discount means 20 multiplied, this will be the 80%, the value will be the 80%, right? The value will be the 80%, so this will be the 16. Okay, so this will be 16 here, 16. Okay, so 16, but if this value will remain same, if this value also in total will remain same, if total this total value will remain the same, right? 18, 18. So how much, by how much amount, by how much amount, by how much amount, how much right issue we have to issue in shares so that this will become 18. Okay, so if for example this is 18, we divide it by 16, then how much is the value? 0.125. So 1.125 shares we have to issue to get the same value of right issue. Okay, so I will add this as well here. So 5, so 4 plus 4 plus 1.125 equal 5.125 here. Okay, so what is the value of TRP now? Now the value of TRP will be 19.12. So okay, so this 19.6 here, but now the value of TRP is 19.12, which means the TERP value has decreased. Okay, the TERP value has decreased. So the TERP value, this means the change, since the total amount would be same, TERP value would have fallen. The TERP value has fallen. Okay, so this is the correct answer here. So indicate by clicking the relevant boxes whether the following statement about discount on right issue are true or false. Okay, statement about right issue is true or false. Okay, the level of discount is simply not relevant, not relevant to the discount, not relevant to the wealth of shareholders as long as they accept the right. It is ignorance of the theory that encourages the offer of a discount in most cases. It is ignorance of the theory that encourages discount in. So this statement is true because the discount is not relevant because the shareholder wealth, as long as they accept, because when they accept the offer, so shareholder wealth shareholder wealth does not change. Okay, shareholder wealth does not change, so this is the correct answer. Okay, next is the bigger the discount, the more likely a shareholder is likely to accept. So here, if even if here that if you accept, your wealth will not change. Even if you transfer, even if you sell the right, then it will not change. But when you do nothing, then it will change. Okay, so but when you accept this, when you accept this, because if you get the higher discount you will accept, because here when you sell the right you may not get this value of right. This is value of right you will get as a commission, when you sell. But this commission is the maximum you can get. So the maximum you might not get, you might get 0.30 or might be 0.35. Okay, so in order to get the maximum the value of the right, so when you take the when you buy the right issue, then you can only get the maximum benefit out of the right issue. In this case, when you buy, you will get the maximum benefit. The bigger the discount, when you have the bigger discount, so you will get the, it is likely that you will accept. Okay, which of the following actions by shareholder would be the worst thing to do in relation to right issue? So the worst thing a shareholder can do is the do nothing. Okay, do nothing is the worst thing, because doing nothing will reduce the shareholder wealth. Because doing nothing will reduce the shareholder wealth by 200 here. Okay, when you do nothing, then your shareholder wealth will reduce. But when you take the right issue, or when you sell the right issue, then your wealth will not change. So doing nothing will lose your wealth. Doing nothing is the worst option. Okay, which of the following action will result in least dilution of control for existing shareholders? Least dilution of control means the ownership. Okay, the ownership. Least loss of ownership. Which of the options list loss of ownership for existing shareholders? Okay, when you accept the right offer without negotiation, when you accept the right offer, then it is the least dilution of control, because you will remain the owner. But when you refuse the taking the right and you sell, then the other party will become the owner. Okay, so this is not the right answer, and sell nothing, and you will lose your shareholder wealth. And also here in this case, that when you don't do anything, then definitely you have the 1000 shares here, you have 1000 previously, so the 500, you by the value of 500 shares, you lost the control in proportion, because the existing shareholders who take the right will get 500 more shares, and you will only remain the 1000. So the you will lose the ownership of 500 shares if you don't do anything. Okay, so sell the 50%, then definitely you will lose the control. Okay, so A is the right answer. Okay, Dominance company is considering raising some new finance. Okay, so he's raising new finance, that is but there is a disagreement at board level how best to proceed. Okay, so the management directors think that the company should retain control. So they have to they have to raise the finance, but they are considering to retain the control. So which finance they can issue so that they can retain the control, because issuing debt will retain the control. Okay, you know that issuing debt holders don't have the ownership right. Okay, so don't debt holders don't have the voting right, or I can say that don't have the right to interfere in the management. Okay, so in debt holders will definitely don't control the business, or the business will remain within the control of the existing shareholders. Okay, so the finance directors feels that the gearing level should be allowed to increase the level of benefit from tax relief allowed on the interest. So the finance director told feels that gearing levels should be increased, means you have to raise, you have to issue the debt, and by raising the debt you will also get the tax benefit. So this statement is correct. Right. Okay, so next is the existing equity is quoted. The equity shares are quoted at $4.2 come right. Okay, so this is the P0, that is come right, come due. Okay, and the dividend is, this is the dividend. Okay, on, so the company earning have grown a fairly steady rate. So in the past, the company growth rate is 8%, but it is expected that growth to be 2% better, which means that it will be, the growth rate will be 10% for the future, right? Because 8% is already in the past, but now from the future 2% will be the better. So it will be the 10%. Okay, so the company that is 4% redeemable, irredeemable debt, which were issued at 5% discount at 95. Okay, so company is issuing the 4% irredeemable bonds, which is issued at 5% discount. Okay, this is the interest rate, for the irredeemable bonds, and they are issued at 95. Okay, they have the nominal value of 100, they have nominal value and currently quoted at 80, with interest having just been paid. Okay, the corporate tax rate is 25%. The nominal value is 100 and currently quoted, the current price is, they are issued at 95, but they are currently quoted at, this is the market value or price P0. Okay, which is 80, and the tax just paid, interest has just paid, this is the x interest after the interest. Okay, this is after the interest, x interest, x. Okay, the corporation tax rate is 25%. Okay, so the, assuming the business wants to retain the control in the hands of existing shareholders, retain the control in the hands of existing shareholders, how should it seek to raise the new finance? So if the company wants to retain the control, how it has to raise the finance? So it can raise the finance by, the first option is placing means offer means mm, some investors, which means the shares are issued to some investors. Okay, so definitely they have the existing shareholders will lose the control. Okay, for the public, when you issue the shares to the whole world, when you issue shares to the whole world, then definitely you will lose the control. Okay, the existing shareholders. The right issue, where right issue don't means the existing shareholders will get the shares. Okay, so not there is no dilution of control, but where is it is expected that only 95% of existing shareholders will accept the offer, which is 5% is the dilution, 5% of dilution of control here. Okay, this can be better option, but issuing that there is no dilution of control, there is not even 1% dilution of control, right? Because that holders don't have the right to intervene in the business affairs. Okay, so this is the correct answer. Assuming the business wants to maximize tax shield, okay, on the new finance, how it should raise the money? So tax shield, maximize the tax shield. So in which finance you get the tax shield benefit? In debt. When you issue the debt, when you raise finance through the debt, you will get the tax shield benefit. Okay, so placing of new shares of the preference shares, no. Accepting a venture capital offer includes 504% irredeemable bonds and some shares you will not get the tax benefit on that. Okay, and preference shares you will not get the tax benefit on that as well. Okay, when you sell redeemable debt with a market value with interest 5%, you will get the benefit of interest on that but it will be only 12 12 million 12 million, okay, 12 million multiplied 5%. So you'll get the 5% tax benefit on this interest. You will get the how much benefit? You will get the uh, interest that is deductible is 5%, but here this will be this will be this we have to multiply it by 100, so this will be 5.25. So here you are getting the benefit of 5.25% that can be deductible from the profit before tax, PBIT. Okay, so you will get the tax benefit here, higher tax benefit you will get because of this interest. Okay, so this is the correct answer, right? So let me calculate this, the 12 million in 5%. This 12 million 5% is 0.6 is the interest, okay, and this 12 multiplied 5.25%, 0.63%, 0.63 interest. So this is the 0.6 0.6 million is the interest, and here it is 0.63 million interest. Okay, so you are getting higher interest here, so this will be deducted from PBIT. So your profit that is profit available for tax, profit that is profit before tax will be lower here. Profit before tax will be lower here, which means you are getting the tax benefit because of this interest, right? So D is the answer, correct answer. What's the percentage of cost of equity? Cost of equity nearest one decimal. Okay, cost of equity nearest one decimal. Right now, the cost of equity is cost of equity is cost of equity is D. The formula for cost of equity is D1 plus G P0 plus G. Okay, so dividend is 0.161 plus 0. That is 10% is the growth rate, and we have the price that is given here, the P0 4.2, that must be after the dividend, that must be X div. This price must be X div. So we have to 4.2 minus 0.16. Okay, 2 minus 2 minus 0.6. So you will get answer plus 0.10. So how much is the answer? Answer is 1435. Okay, so you have to multiply it by 100. You multiply it by 100, you will get 14.35. So that must be for the one decimal. So you will consider this as, so this is 5, so you have to increase this to next 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 point. Okay, next decimal point. So this will be 14.4. If next is the cost of debt after tax. That is interest 1 minus t divide p0. Okay, so interest is 4, 0.4 1 minus 0.2. Okay, 40 minus 0.25. P0 is how much? 0 is the price, that is 80 here. Okay, so 80 is the price. So 3.7 is the cost of equity of Dominance company is significantly higher than cost of debt. Okay, so cost of equity is 14. So cost of equity is, this is cost of equity, this is cost of debt. Cost of equity is 14, but the cost of debt is only 3.7%. So what is the reason behind this? So reason is, one of the reason can be the tax shield. Okay, one of the reason can be the tax shield, but because tax shield is 5, that is the 4 is issued at 4. So the tax benefit is only, tax benefit is only, so tax benefit is only 1% here, but this difference is very big. So one of the reason can be, the other must be the total risk level in the business. No, the because the business risk and financial risk, the total risk cannot be the reason, because we are comparing the cost of equity with the debt, not the project. So the business risk has not changed. Okay, so this cannot be the answer. The specific risk in the business, specific risk is specific risk the unsystematic risk. Unsystematic risk, systematic risk, unsystematic risk can be diversified by diversified by holding diversified portfolio. So if this business, the dominance company business is risky, then you can invest in another business. Okay, so you don't have to invest in the same business. Okay, so you can invest in other businesses as well, so that your portfolio don't become very highly risky. Okay, so this is one of the assumptions that we assume, when we use the CAPM. Okay, CAPM formula. So the unsystematic risk can be diversified away. So this cannot be the reason. Okay, so one reason is the tax shield, but the next reason can be the level of unsystematic risk. That is general risk. That is general risk in the business. That is only, so that difference can only be due to this general risk. That is the economy or anything, these tax policies, these type of risk can be the reason. That's why the difference is so big. Okay, so that this D must be the correct answer. The board of Empire Company discussing their dividend policy. They are discussing about dividend policy, and there have been various statements made by the directors, and these are the statements that made by different directors A, B, C, D. Okay, so our shareholders, director A, our shareholders rely on the level of dividend we pay, and we cannot ignore that. we must pay out a dividend as expected. Otherwise, our shareholders will be forced to sell the shares to invest elsewhere. So our shareholders that rely on the dividend, and we cannot ignore that. We must pay the dividend as they are expected. Okay. So this is the statement given by director A. Director B, I know that when I was young, that I if I get a rise, if I get a rise in allowance in a particular week, I was more likely that I will get it again. Okay, and it was expected that we must pay what is expected. Okay, the director say what matters is the underlying value of the company. What matters is the underlying value of the company is of the project is the most important for the shareholders. Director she said that we are doing now and that we will do in the future. We must stop wasting discussing time this. Okay, so director D, what matters is what we can afford in cash. What we can afford in cash. If we are short of money, then we should we should be end in discussion a lower or even no dividends should be paid. In no dividends should be paid. What could then do is to issue more shares instead, and I think this is called a script dividend. Okay, and afford in cash. So these are the which directors support dividend irrelevancy theory, which directors support signaling effect, which directors support dependency theory. Okay, and which director is concerned about company liquidity concern. And once the discussion about dividend policy was finalized, there was another discussion about scrip issue. Indicate by clicking in the relevant boxes whether the following statement are true or false. Okay, so which director support the irrelevancy theory, irrelevancy, signaling, and dependency and liquidity. Okay, so the first director is about because the shareholders rely on the dividend. So can we say that dividend dependency? This is related to dividend dependency because the shareholders are depend on the dividend. Okay, and the next is the if I get a rise allowance, then it is more likely that I will get it again. So this is about the signaling in which if the company distribute dividend in previous year, then they expect that in the future years it will distribute dividend as well. In the future years the company will distribute the minimum this percentage at least. If for example this distributed $10 here, so they expect that at least the company will distribute $10 every year. Okay, so these are the expectations and this is called the signaling effect because of the past expectations. Okay, so what matters is underlying value of the company, and this is about irrelevancy theory. What is irrelevancy theory? So you should invest in positive NPV project. If you invest in positive NPV project, the wealth of shareholders will increase. The wealth of shareholders will increase. The value of company will increase, and that value, if the company would not pay the dividend, that value will ultimately the shareholders sell some shares and get the dividend as a form of capital gain. Okay, and if the company value don't increase, then they will definitely sell. I mean, okay. So next is the next is the director D. What matters is what we can afford in cash. So what matter for the dividend is we can afford in cash. If we so This is talking about something the liquidity. This is talking something about liquidity because it is related to cash. So more shares instead. So we call scrip dividend. So dividend, no dividend should be paid. If we are short of money, then it should end of the discussion a lower or no dividend should be paid. What we could do then issue the scrip dividend. This is talking about the liquidity. So the irrelevancy theory is director C is talking about support the irrelevancy theory. Signaling effect director B, signaling effect director B. Independency is director A, and company concerned about liquidity is the director D. Okay. So once the discussion about dividend policy finalized, the another discussion about the script issue. That is here that in the end they are talking about the script issue. Script issue means bonus issue. Bonus issue. These are free shares. Free shares free shares given to shareholders. Okay, in scrip issue shareholders will end up with more shares. This means they will be a gain to them. They will get more shares, but will they will gain to them. So there will be no gain to them because the shareholder wealth will increase when you get the more shares. But when the increase in shares when the increase in shares will decrease the market price of the shares afterward bonus issue. So when the market price of the shares will increase, then the after that the shareholder wealth will decrease. So on the one side, when you get the dividend so when you get the bonus issue, is your wealth will increase by that shares you get. But after the bonus issue, the wealth, the market price of the shares will decrease and your shareholder wealth will decrease. Okay, so this will compensate each other and you will gain nothing. Okay, you will gain nothing from here. Okay, next is script issues serve the purpose of reducing market value in return for more shares. Okay. So script issue reduce market value. So increase in shareholder wealth first, then reduce the market value. This is correct. This can make the shares more marketable. This can make the more shares marketable when the market price will decrease. When the market price reduce, the more those shareholders who cannot afford the shares at that high price, now they can afford that share at the lower price. Okay, so the marketability of the shares has now increased. So this is correct. Okay, the board the board of major bank the board of major bank is discussing about investment appraisal methodology, as they have a new project under consideration. Okay, they are this is a bank and the board of the bank is considering the investment in a new project, and they are considering they have agreed using CAPM approach, sensible, as they have feel it likely that most of their shareholders will have a well diversified shareholdings in the stock market as a whole. Okay, so to appraise the investment appraisal, they are using the CAPM approach. Okay, so there has been some dispute about which risk constitute specific risk in the bank and which risk constitute to systematic risk. Specific risk is unsystematic risk. Unsystematic and systematic. Unsystematic and systematic. And unsystematic risk is specific risk and systematic risk is general risk. Okay, unsystematic risk and systematic risk is general risk. Okay, partly driven by the nature of the bank's operation. Equally, no one seems quite sure what the required return derived from the CAPM formula actually represent. Okay, so they are also not sure about the what the required return from the CAPM formula actually represent. Okay, the finance director has produced the following data relating to bank itself, the financial market, and the new project is considering. So they have produced these data for the consideration. So the required return for the existing debt, the required, and the cost, that this is the required and this is they are providing, and the required on the return on the short-term government securities is 5.2. And you know that government securities are risk free because government don't default. When you give money to government, you can expect that your money will be returned by the government. Okay, so these are considered as risk free, and this is the risk free return in the stock market. So this is the return of the market. And equity beta of the bank. So equity beta of bank and beta of the new project. This is the beta of the new project, and asset beta of the bank. So this is the asset beta. Okay, and this is the equity beta of the new project. So which two of the following risk correctly describe systematic risk? And systematic risk is what? Systematic risk is general risk. So okay, so we have to find the general risk. So interest rate set by the bank. So bank interest rate is generally for the specific business. So for based on the credit history, the bank set the interest rate for specific businesses. Okay, so this is this is specific risk. Okay, so this is specific risk. We have to find the general risk of default by the bank customer on loans made. So risk of default made by the bank customer. So it depends upon which type of customers a bank have. So if a bank have low profile customers, or if a bank have, I mean, those customers who don't repay the loans. So it depends which type of customers a bank. So it is specific risk. So it is specific risk which depends on the customer. Okay. So these are not general risk. The recessionary recessionary pressure in the country in which bank operates. This is the general risk, because the recession is the general risk, because recession impact all the businesses and the country, the whole country, even sometimes the whole world. Okay, so the recession impact the all businesses. So this is the general. We have to find the two general risk. Demand for the loan made to the bank. So demand for the loan. So for the specific bank. So if this, for example, this bank is providing loan at very lower interest rate. So the demand for the loan for those customers who wants to borrow money from this bank will be higher. So this is specific. This is specific to this bank. So change in government after a general election. So government change. So there is no specific government for specific businesses. So government is for the whole country, and it impact the whole bu- all businesses. Okay, so this is general risk. Next is the CAPM. In the CAPM, what would be the value to use risk-free rate of return from the above data? So in CAPM formula, you know the CAPM formula, the cost of equity, we have to calculate the risk-free return plus how much risk you are taking must be multiplied by risk premium, which is market return, and the risk free. Okay, so it says that which rate, which risk free rate we have to take here. So it is which rate we have to take here to calculate this calculation in the CFM formula. Okay, so which rate we have to take? We have to take the risk free return, that is the government securities, which is 5.2. Okay, next is in CFEM formula, R equal RF plus BJRM minus RF, where BJ represents the project beta. Okay, R represents the cost of cost of which is the required return, which is the required return on the new project, is the required return on the on the specific project. Okay, is the required return on the new project. And you know this is the risk free premium, and this is the risk free premium. You have to select this, you have to select here this. You have two options, you have two options, first and second. You have to select out of them. So the answer is for this, and for this one, this. Okay, what is the percentage required return on new project derived using CAPM two decimal? So we have to calculate this value using this formula. Okay, so the 5.2, we know this, plus the equity beta of the new project 1.52, 1.52, and market return is 12.8, 12.8, 12.8, 12.8, 12.8 minus 8.2, the risk free return. Okay, so we will get the answer here is 16.75, 16.75. Calculate the two decimal, 16.75. So what is the meaning of beta value of 1? So you know that beta value of 1 means the risk is equal to the risk is risk of project, risk of invest, risk of project is equal to the risk of market. Okay, so when you have greater than 1, which means higher risk, greater than means higher risk, higher risky project, and less than 1, lower risk, and equal 1, have same risk. Okay, so here it's the risk, investment risk free, the investment has same level of risk as the bank. No, bank is the market, same return as the market. Okay, the investment total market is risky, you know, the investment total risk is as risky as the market. The investment has same level of risk, not the total, not the total. Total means systematic and unsystematic. Okay, but here we are only considering about the systematic risk in the CAPM. Okay, so systematic risk, that is general, which cannot be diversified. So same systematic, systematic and same systematic risk. Okay, This is the correct answer. Okay. The board of Fredling company are in discussion about various risk types that face the business. It is evident that there is a considerable confusion and disagreement. Confusion. There is so much confusion and disagreement among the directors, the board. Okay, so the operating risk and the gearing risk. Some of the directors feel that given the increasing volume of trade, having the increase in the trade, now the trade is increasing, having fixed cost, which increase the fixed cost, increasing the trade, having fixed cost, the best thing to do. They said that the trade is increasing and the fixed cost as well, and increasing fixed cost is the best thing. Okay, so, but you know that you are the financial management expert, and you know that when the fixed cost increase, and when the fixed cost increase, this is not a good thing. Why? Because when in case of decreasing sale, you have to pay the fixed cost. When you pay the fixed cost, your profit will decrease. Okay, your profit will decrease. Even if you don't have any sale, you have to pay the fixed cost. This is the risk. But it is saying that increasing the volume of sales, the fixed cost is the best thing. Okay, in case of increasing sales, it is the best thing, but in case of decreasing sales, this is not a best thing. How can it be risky? So they are questioning how this can fixed cost can be risky when we know how much they are, and they don't change very much from one year to the next. Okay, this is the confusion among the directors. The next is the gearing risk. The directors were more aware of in this area. They are aware in this area. This gearing risk is also known as the financial risk. The financial risk is about the interest, and this operating risk is about the fixed cost. Okay, so, with some favoring a more traditional view of gearing and others remembering M&M fondly from their studies. So, they are aware in this area, and they have also studied the M&M and the traditional theory, but they are confused as well. Okay. So the question is indicate by clicking in the relevant boxes whether the following statement about operating gearing are true or false. Operating gearing, true or false? Operating gearing is about fixed cost. Okay, given the level of fixed cost does not change considerably one year to another, one year to the next, having a lot of fixed cost in Fredling cost structure would mean that they had low level of operating risk. Now, high fixed cost lead to operating risk. So this is false. When the fixed cost increase, the operating risk increase. The variable costs are risky because they change as volume changes. Yes, the variable cost change when the volume change. Yes, this is correct. Given Fredling is growing year on year, variable cost level has changed. Well, okay, so variable costs are risky. So they said that variable cost change with the change in volume. Yes, they change, but variable cost is risky. No, this is not correct. Variable cost is not risky because when the variable cost change, the sales will change as well. So, for example, if the sales change by 10%, if the sales increase by 10%, so variable cost also increase by 10% as well. So they cancel out each other. So this is income for us, this is cost for us. Okay, so they cancel out each other, and the effect is nothing. No. Okay, so this is false. Okay, so variable cost is not risky. Next is in relation to changing the gearing of pedaling. Which of the following statement are true? Changing gearing is increase in debt. It means they are they are either they are taking the debt. Okay, as a debt, it as debt is more risky for the company. Yes, debt is risky for the company. It is more expensive than equity. It is more expensive than equity, including high proportion of debt in the capital structure will therefore increase the WACC. So it is says that debt is risky for the company, more risky for the company. It is more expensive than equity. So debt is expensive, less debt is less expensive than equity because debt holders get fixed return in form of interest. So when they get fixed interest in form of interest, their expectation is also lower. So the debt expense is cheaper than the equity. Okay, this statement is false. Okay, equity shareholders respond to the increased risk when the company equity shareholders respond to the increased risk when a company includes more debt in the capital structure by increasing return they demand from the company. Yes, this is correct. And you know that in the traditional theory, when you increase the debt, when you increase the debt, then the future those prospect then the future debt holders and equity holders will consider this company as risky because this debt this debt interest is this debt interest is this debt interest is paid here. Okay, profit before tax, then you pay the tax. Okay, then you pay the tax here, and what is it available here? Profit after tax, then preference dividend, then you pay the preference dividend. Okay, then you pay the preference dividend, and this is profit available to equity shareholders. This is profit available to equity shareholders here. So first you deduct the equity, sorry, debt interest. So so first when you increase the debt, so debt holders will get their interest, but the equity holders don't get any return when you increase high amount of debt, and this interest will increase ultimately. So the equity holders don't have the available profits to get their return. Okay, so this is the risk. So when you increase that, they will increase the cost of equity as well. The expectation of equity holders will increase, so they demand higher return from the company. So this is correct. Statement 2 is assuming. This is another question. Assuming that the board were considering raising more debt, indicate by clicking the relevant boxes whether the assertion that the whack 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 fall. So this is the promise made by the board that the company company whack will fall company WACC will fall when you increase the when you increase when you increase the debt, the WACC will fall. This is the promise made by the board. Okay, so let's consider in case of M and M no tax. In case of M and M no tax, can you draw the graph? The graph is like this. When you have no tax, then this will be the cost of debt. This will be the cost of equity and the WACC. Okay, and the WACC. So the when the debt increase, the WACC will WACC will reduce. WACC will reduce. No, because WACC will remain stable. Okay, so does not hold true. So WACC will not reduce. So this is not true. Does not hold true. Okay. Next is the next is the M&M with tax. So same graph, but only difference is when you have the tax, you get the tax benefit, and when you get the tax benefit, the WACC reduce because of tax benefit. Okay, so when your debt increase, the WACC will reduce. This is true. Okay, at the lower level of gearing, and we throw this. Let's throw at the lower. So this is like this is cost of debt, and this is cost of equity, and and this is what. Okay, there is optimal WACC point where WACC is the lowest. Okay, so at the low level of gearing here, the low level of gearing here, this point, the low gearing of traditional theory. This is the traditional theory of gearing. So at low level of gearing, the WACC fall. At low level of gearing, the WACC is falling, right? This is falling. So this is true. The next question is, under the M&M no tax theory of capital structure, which of the following is true? We have to consider this no tax, this, okay, this graph. It does not matter how a business raise finance, no, because this M&M no tax, this only consider cost of equity and the cost of debt. It does not consider the right issue. Okay, it does not consider the right issue, redeemable and irredeemable. So it only consider the debt and equity. It does not consider the right issue and bonus issue. So this is not correct. Okay, shareholders given shareholders given the M&M assumption will recognize the level of risk inherent in any extra debt. Shareholders given the M&M assumptions will recognize the level of risk inherent in any extra debt. Shareholders given the M&M assumptions will recognize the level of risk inherent in extra debt and compensate themselves by commensurate increase in required return to leave the company back unaltered without any inherent gain. So it says that the this this when the debt increase, this statement is saying that when the debt increase, cost of equity will increase as well. This is correct. And when the debt increase, which means that financial risk is increasing. Yes. When the financial risk increase, cost of equity holders expect more return. So they are expecting more return here, right? And these expectations will compensate each other, and the WACC will not change, and WACC will not change. So the WACC is not changing here, so WACC unaltered. So this is correct, and 2 is In diagram of the traditional theory capital structure, the cost of that line is often drawn as a straight tail. So the traditional, this is the traditional diagram, traditional, this is traditional theory, this diagram, and it is talking about this tail, okay, it's talking about this tail here, this tail. So it says that the cost of that line is often drawn as a straight tail. Yes, this is drawn as a straight tail and then it increases upward. It is straight tail and then increasing upward at very high level of gearing. Yes, indicate by clicking in the relevant boxes whether the following statement is true or false. Okay, the rising tail represents an increased risk to debt holders. Yes, because when the you take the high interest, when you take the higher debt, when you take more and more debt, the new debt holders will will consider this company as a risky company, and they assume that you or company may not pay the required return, the interest, and they will afraid, they will reluctant to invest in your company. So if they invest, they expect higher return. Okay, so rising tail represents increased risk for the debt. This is true. Tax exhaustion can increase the cost of borrowing at high level of gearing. Some can increase the borrowing at tax exhaustion can increase the cost of borrowing at tax exhaustion can increase the cost of borrowing if the tax exhaustion no tax benefit, when you don't have tax benefit on the, and you know that the debt is cheaper because of tax benefit, and when you don't have the tax benefit on the debt, the borrowing, so this will become expensive, this will become expensive. So this statement is true, right? And in practice business rarely reach this point. It says that in practice this point, when you take higher and higher debt, this point never company never reach, because 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 the banks don't lend despite high interest rate possible. Instead, the company is ready to pay the high interest. The banks will not lend the money to the company because they already taken so much of it. So that's why they don't lend the company, because they see this company as a risky company. So this is true, right? Tulip company is a large company with an equity beta. The equity beta of Tulip company. This is the equity beta of Tulip company. Okay, the company plans to expand existing business by acquiring a new factory. So they are planning to acquire new business, which is a factory. Okay, the cost of acquiring is 20 million. Okay, the finance for the expansion. So because they don't have the finance, so they are financing the expansion with from an issue of 3% loan note. So they are taking 3% loan note at nominal value. This is the nominal value of the loan note, and these loan note will be redeemable, and these are redeemable after 5 years, after 5 years at nominal or convertible, at the convertible price. Okay, so they are financing this new factory by taking 3% loan note, and this 3% loan note must be repaid by the company after 5 years at nominal or convertible. Okay, at that time into ordinary shares, in Tulip company with a value expected to be. So this is the convertible value. Okay, either the either the finance provider can take 100. Okay, either they can take 100 or 115 at the end of 5 years. When at the end of 5 years, so they have the option, the finance provider have the option, either they can take 100 which is nominal value, or they can convert their debt loan note into the shares, which is ordinary shares, at a price of 115. So which one they will choose? Definitely they will choose 115, and this will not choose the they will not choose this 100. Okay, so the risk-free return is this, and the equity premium is this one, RM minus RF. This is the risk-free premium. Okay, Tulip company is seeking additional finance and considering using Islamic finance. So they are seeking additional finance. So additionally of loan notes, they are additionally taking the finance and considering this time the Islamic finance. Okay, and particularly would require a form which would be similar to equity finance. So do you know which is similar to equity finance in Islamic finance? The Madaraba is the similar to equity finance. So they will take this from the Islamic bank. Okay, so what is the cost of equity of Tulip company using the CAPM model calculated? So which one beta we have to use? We have to use the Tulip company equity beta. Okay, so we have to calculate the cost of equity, and the formula for is this. Okay, risk free return plus whatever the risk we are taking, and on that we have to multiply it by premium. This is the RF minus RM, this is the premium, and this is the risk. Okay, so risk free return is 2.5 plus beta is 1.05, and the premium is 7.8. So you have to take you the cost of equity is now 10 10.7%. Okay, next is using estimates of 5% and 6%. What is the cost of debt of convertible loan notes? So do you know how to calculate the cost of convertible loan notes? So in order to calculate the convertible loan notes, we have to apply the IRR methodology. Okay, in IRR method, what we do? We have to take first the lower rate and the higher rate. Okay, we have to take the lower rate and the higher rate. Okay, so based on this we have to calculate the IRR. Okay, so this side I will write year 0, 1 to 5 and 5. Okay, so these are the cash flow. In year we will get, which is a liability for us. Okay, so deduct minus, and this is the payment we have to make every year, which is interest 100 multiplied 3% equal 3, and we have to make this payment every year. Okay, so and after 5 years this will be converted into 115. So they will take 115. So they have to take 5% and the present value. Okay, and 6% here and the present value. Okay, so at 5%, what is the at 5% on year 0, this will be 1, and we have to take the annuity of annuity of 5%, annuity at 5% for 1 to 5 years. Okay, so the annuity is 4.529. This is the annuity for these years. Okay, and the for the 7th year we have the discount factor, which is this. Okay, now we have to calculate it. So the present value is this 100. For this we have to multiply 3 into 4.52 4.329 and this is 784. Okay, so this is 12.99 and this is 90.16. Okay, and the total is 3.15, and at 6% this will be 1. And annuity, and we use annuity table when we have same cash flow, which is inflow or either outflow. So we have same cash flow every year, then we will take the annuity. You can use the discount factor as well, but when you consider the annuity table, this will be very simple. But when you consider the discount factor table, this one, then you have to separately multiply it by every year. So I will recommend that you have to use the annuity table instead. Okay, so every year we are paying 3, and at the 6% we have to calculate at the 6% annuity. At the 6% annuity for the 5 year is 4.212. Okay, 4.212, and we have, this is only for the single year, this cash flow only given for the single year. So discount factor at 6%, discount factor at 6%, discount factor of 6% for the for this fifth for the 5th year. Okay, so it's 747, it's 747, it's 74. Okay, now 112.64 and 85.9. So now the answer is 1.45. Okay, now we have to consider this. We have to take the lower rate plus NPV. This is NPV, this is NPV, NPV at lower rate, NPV at lower rate, NPV at higher rate. Okay, so NPV at lower rate. Okay, and then we have to take the NPV at lower rate, deduct NPV at higher rate. Okay, then we have to multiply it by the difference of higher minus lower rate. The difference is 1%. Okay, so the lower rate is 5 plus NPV at lower rate is 3.15, and the NPV at lower is 3.15. This is minus, so we, and in formula we have the minus, so minus will be plus 1.45, and the difference of higher rate and lower rate is 1, so 1 here. 5.7% is the answer. Okay, so guys, if you want to calculate this, I mean, I take this as an annuity. This is the annuity rate, this is the annuity rate. But if you want to take this discount factor. So I will explain 1, 2, 3, 4, 5. So every year 3 is the cash outflow. This is the year, this is the cash flow. Okay, so now you have to calculate it at, I'm calculating at 5%. Okay, so at 5% you send discount factor at 5%. This is the present value, and discount factor at 5%, you have to take this 0.925. Actually I have to write it 0.925, 0.952, 925, 907, 907, 864, 864, 823, 784. Okay, when you multiplied this with this with this, and when you multiplied and you total this, when you add this amount, then you will get the same answer of 12.99 here. So you can do it by yourself and check whether this answer is correct or not. Okay, it is correct because every time it will be same, because this 4.329 is the addition of these. This 4.329 is the total of this, because we added this and then multiplied it by this. So answer will be the same, this 12.99%. So you have, next is in relation to tulip company asset CAPM model, which of the following statement is correct? Okay, the model assume that all shareholders have same required rate of return. Yes, this is correct, this is correct. In relation to using CAPM model to value tulip company, which of the following statement is correct? Okay, the model assume all shareholders of tulip company have same required rate of return. This is correct because these shareholders, the KE using the CAPM model is the expectation of all shareholders. This cost of capital is the expectation of all shareholders from the company. Okay, so this cost of equity is not paid to specific shareholders. Instead, this cost of capital is paid to all the equity holders. If company is paying the 12% return to the shareholders, then each shareholder will get the 12% return on the investment. Okay, so this is correct. The model assume a constant share price and constant dividend growth for tulip. The dividend is not considered in this model. The dividend and price is not considered in this model CAPM. Okay, the model assume that capital market are semi-strong. So this is the assumption that the capital market are semi-strong. This is not the assumption. The assumption is perfect capital market. Perfect capital market is the assumption. Perfect capital market means there is no transaction cost, and no tax, and information is freely available. Information is freely available to investors. So this is the characteristics of the perfect capital market. So this is the assumption of the CAPM model, that it is a perfect capital market, not the semi-strong. So this is wrong. The model assume that tulip company interim dividend is equal to final dividend. So dividend is not considered. This is wrong. Okay, in this CAPM. Which two of the following statement about equity finance is correct? Which two of the following statement is correct? Okay, equity finance reserve represent cash which is available to company to invest. Yes, equity finance is the reserves which is cash which is easily available to distribute, but it is not only to invest, but it is also available to pay as dividend, or you can use this for the future to buy any machine. So it is not only for the investment, it can be used for the distribution of dividend as well. So this statement is not totally correct. Okay. Additional equity finance can be raised by right issue and bonus issue. Finance can be raised by right issue. This is right. But finance can be raised by bonus issue? No, because bonus issue is free issue. Bonus shares are given free, so there is no cash raised, so there is no finance raised. So this statement is not right. Retained earnings are source of equity finance. Retained earnings are source of equity finance. Yes, this is correct, because the retained earning is the profit that is available to equity shareholders and not distributed as dividend. So if it is available for the equity shareholders and not distributed as dividend, then it is retained in the business. When it is retained in the business, this belongs to the equity holders. So this is a source of equity finance. Okay, and company can use this retained earning for the future. Equity finance includes both. Equity finance includes both ordinary and preference shares. Equity finance only includes the ordinary shares, not the preference. Okay. Cutting dividend, cutting a dividend provides a source of equity finance. Yes, cutting dividend means it is providing the source of finance. So I already told this is profit available. If it is not distributed, then it will go to retained earning and it will become the source of finance, source of equity finance. Okay. Regarding Tulip Company interest in Islamic finance, which of the following statement is correct? Interest in Islamic finance, they want to raise finance through equity, and which equity instrument is equal to equity is Madarba is equal to equity finance. Okay, this is Maraba is the trade credit. So this is not correct. Madarba is correct. Madarba is the equity. Madarba is equity, and which involves two parties, partner 1, partner 2. A partner 1 provide the finance, another partner provide the knowledge. Okay, the involves two partner, investing partner is the finance provider, and the managing or working partner which has the knowledge and work in the company Okay, so the for the E, the second B is correct. Okay, next is 251. Nicole company needs to raise more capital and wants to identify more appropriate capital structure. So they are looking for optimal capital structure. Okay, to maximize this shareholder wealth. You know that where is the optimal capital structure? Where is the optimal capital structure? When lowest WACC. When there is lowest WACC, it is the optimal capital structure, and when there is lowest WACC, it is the shareholders wealth, the maximization of shareholder wealth. When there is lowest shareholder WACC, the maximum shareholder wealth will be there. Okay, the company has approached you for advice on aspects of its financial and operating gearing. Okay, the following has been extracted from Nicole Company 20x9 financial statement. Time revenue is given, operating profit for the tax, profit for the year, dividend paid, ordinary shares, and 8% loan note. Detailed analysis has shown that variable costs are equal to 60%. This is variable cost, which is 60% of the revenue. You have been informed that it is company policy to calculate operating gearing, as this is the calculation we have given for the this formula is given for operating gearing calculation, and you know what is the formula for contribution. How can you calculate contribution? Sales minus variable cost. Okay, the directors of Nicole Company are also seeking advice on the optimal capital structure. They are aware of the M&M model, but seeks further information, in particular in respect of what is meant by market imperfections. Okay, so market imperfections when there is tax and there is tax and there is transaction cost. There is transaction cost and the information is not freely available. Okay, this is called imperfect market, and the perfect market is the opposite, when there is no tax, no transaction cost, and the information is freely available. Okay, so now we have to calculate the operating gearing. So operating gearing, let's calculate operating gearing. Contribution is sales, which is 9540 minus 60% of this is 9540 multiplied 60%. We have to deduct. This is the contribution. And operating profit is given 1590. So now we have the answer 2.4. Okay, 2.4 times is the operating gearing. Now we have to calculate the interest gearing. Interest gearing is PBIT divided by the interest. Okay, so PBIT is operating profit. Operating profit is also known as the PBIT. 1590 divided by the interest. Interest is 3125 applied 8%. So what's the answer? Answer is 6.36. So now we have to calculate it to one decimal place. Okay, so for this we have to now ignore this first first number, then we have to consider the second is above the 5, the 6 is above the 5, so we will increase this to 4. Okay, we will increase this number to 4 because this value is above the 5. This is 6 above the 5. Okay, so we have to consider it to the one decimal place, so we have to raise the number to 4. 6.4 is the answer. Which of the consistent with traditional capital structure theory? So in traditional capital structure theory, can you draw the line, the graph? The graph is for KD, and this is for cost of equity. This is for WACC. Okay, and there is a optimal point. There is optimal point here. This is the optimal point, optimal capital structure where WACC is the lowest. Okay, so also you can draw the when the WACC is lower. When WACC is lower, the value of the company, the market value of the company will increase. So it will increase. When the WACC become lower, the value will increase, but when the WACC increase, this will become the market value will drop. Okay, there is no optimal capital structure. This is wrong. In traditional theory there is a optimal capital structure. Okay, so next is the value of company remains unchanged with increased gearing. The value of company change when there is change in gearing. So here the company, the when the debt is increasing, the gearing increasing, the value of the company is increasing because the WACC is lower here. Okay, so this is wrong. Cost of equity is higher when there is a high proportion of debt. Yes, when there is high proportion of debt, when you increase the debt, the equity is rising. When the you are increasing the debt, equity is rising. So this is true. There is a point which the WACC will be minimized. This is the lowest. So this is the point where WACC is the minimum. This is also correct. Okay, you can solve all the types of question, the M&M, traditional and no tax theories by just using the graph, by drawing the graph, and you can solve any question. Okay, responding to the director's request for advice, which of the following is consistent with M&M tax? So in M&M tax, you can you draw the diagram, the M&M tax. This is the WACC and this is the cost of equity. Okay, M&M tax. The value of nickel company decrease with increased, the value of company in decrease with increased in gearing. The value of company, value of company, the value of company will increase because the WACC is decreasing. So the value of company will increase. Value of company will increase. Value of company decrease when the gearing increase. When the gearing increase, the WACC is reducing. So value of company is increasing. Increasing. Value of company is decreasing. No, this is not correct. WACC remains constant with increasing gearing. No, WACC will reduce, 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 and this increase. Okay, optimal capital structure is up made up almost entirely of debt. Yes, because the optimal capital structure in M&M tax theory, the optimal capital structure where there is maximum debt. When there is maximum debt, the because of the tax benefit, the WACC will be lower. So when there is a lower WACC, the point where the lower WACC, this will be the optimal capital structure. So the lower WACC will be when there is highest cost of debt. So highest cost of debt in this case can be 99.9% in this theory. Okay, so this is the optimal capital which entirely of that, almost entirely of that. This is 99%. Okay, the cost of equity remains constant with increased gearing. No, this will increase, not constant, increase. Of equity will increase. In relation to capital structure, which two of the following are valid statement about market imperfections? So market imperfections, you know what is market imperfections? When there is tax, and when there is transaction cost, and information is not freely available. Okay. Tax exhaustion occurs when there is very high proportion of equity equity capital, no, debt capital. When there is high proportion of debt capital, when there is high proportion of debt capital, the tax exhaustion occurs and you will not get the tax benefit. So this is wrong. Debt holders may impose restrictive covenants in loan agreement. Yes, because the future debt holders, when you increase the debt in your business again and again, the future debt holders will put restrictions on the in the loan agreement, so that you cannot take more loan or you cannot sell your assets. So this is true. Agency cost, tax exhaustion, and bankrupt risk encourage very high gearing level. High gearing level. No. Agency cost, tax exhaustion, and encourage very high gearing level. No. Because of this is the output. This is the output. Because of high gearing, tax exhaustion occur. Because of high gearing, bankrupt risk occur. So these are the output, not the input. These are the output, the result because of high gearing. These are not the because of this high gearing occur. So this is wrong. When a company gearing creates a high risk of when a company creates gearing high risk of bankrupt, the WACC of the company will be WACC of the company will be when a company gearing creates a high risk of bankrupt, the WACC of the company will be higher. Yes. When you increase the debt, increase in risk, bankrupt risk, increase in bankrupt risk of the company, that if your company take high debt, if your company is 100% debt company, then it will create the 100% or 90% debt company, then it will create the bankrupt risk for your company, and this the equity shareholders expectation will increase, so their cost of equity will increase, and so the WACC will increase. Weighted average cost of capital will increase, so WACC will be higher when increase in gearing, increase in bankrupt risk, and increase in WACC. This is okay. Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.